Good morning, ladies and gentlemen. Yes, what I was going to do over the next 40 minutes really was review our latest data and our analysis of the latest Glenigan data, really combine that with the wider economic and industry information, really to assess where the UK is going, where UK construction is going, and where the opportunities are likely to unfold over the next couple of years. Starting really with a quick review of where we are in terms of the wider economy. We have economic recovery. This is welcome news and long overdue. It's interesting, these are the latest or recent government forecasts for the economy. A whole series of bars there reviewing really where the chief economists at the OBR have seen the economy heading over the subsequent years. I think the interesting thing about it is that having sort of consistently downgraded the outlook for the UK, the last couple of forecasts have been much more positive, and they've actually been upgrading the prospects for the UK. In particular, they've been upgrading the outlook for the next couple of years, and we're seeing above 2% growth, and that's pretty key and crucial for construction, as we'll see in a moment. So it's a much more positive picture going forward, very much a private sector-led recovery. We're seeing an improvement in consumer confidence and consumer spending, which I'll say a little bit more about as we go through, look at individual sectors. And also improving business confidence. It's still fragile in some respects, but there's clearly an improving picture, improving confidence. And the latest Chamber of Commerce survey today says 2 out of 5 exporters are expecting to employ more people to meet growing export demand. So there's a lot of positive news out there which bodes well for the future. Having said that, it's where we're starting from that's also of interest. And if you can see the overall picture, the grey bar there is the wider economy, GDP growth, or level of GDP. And you compare that with the level of fixed investment, and particularly investment in dwellings and other structures, is very much the construction-related areas. You can see that A, the construction and the construction-related areas and investment has fallen more sharply during the recession, and B, we haven't seen any sort of improvement really, where we've seen some sort of little bit of stabilisation over the last couple of years in the wider economy. And that comes back to Stephen's point really about the importance of investment for the wider economy, that £2.84 figure that he was quoting, that if we can start to see investment there, actually we're going to see a sort of a catalytic effect that's going to really boost and help support stronger growth. And it also is obviously essential to long-term sustainable growth in the wider economy if you've got to have that investment in the built environment and other areas to deliver that. Coming back to the 2% point and why that's particularly crucial going forward, if you look back over the last sort of 30 years or so, you can see that you typically need at least 2% growth in the economy to see any growth in construction activity. And there's only one year where that rule was broken, and that's when we saw A, a change in the way they calculated the statistics, but B, is when the last government was really pulling forward a lot of investment into construction, trying to offset the very sharp fall in construction activity in the wider economy we saw in 2009. The good news is that as we're now moving forward, is looking at stronger growth over the next couple of years above that 2% threshold, we can look forward to stronger growth and real positive growth in construction activity over that period as well. So, again, if you come back to the forecast, what does that mean? As I was saying earlier on, it's very much a private sector-led recovery, and I think that's going to remain the issue as we go forward, both from consumer side of things and from business investment. Again, this is the official forecast being released by OBR for the next few years. And I think that the key message from that is that the government's expecting a surge in business investment, those are the red bars, over the next couple of years, and also a sustained recovery in consumer spending. In contrast, the government side of things is still pretty flat. In fact, they're being relatively positive in they're expecting some growth in government investment going on from 2015 onwards. But that's offset by a decline in government consumption. And I would say is that actually going to be deliverable in reality, particularly sort of post-election? Are they going to deliver those cuts in general government consumption, which frees up the resources to fund investment? If they can, that's all well and good, and that'll add to the pace of growth. But I think the real focus going forward is going to be on the private sector side of things to deliver the growth. And you can see that really as we look at the individual sectors in more detail. If we take the social housing side, which Hilary was talking about a few moments ago, and the sharp cuts that have been going on in that area over the last year, a year or so, or during the current Parliament, in fact, really because of that change in government support for housing. He mentioned the very sharp cut in central government support of around 63%. In fact, it was cut by 50% in 1 year alone when the government first came in, and there's been subsequent declines after that. It's now starting to stabilise, but you can see really how the product mix has responded to that. As well as cutting direct capital support, the government's also been looking to social housing providers to charge affordable rather than social rent levels, which is around sort of 80 to 90% of market rents. So you've got higher rents, which then provides the income flow to support private sector funding to deliver new investment, and really to try and sort of mix with the reduced capital from the government side of things that's available. That's really, it's obviously been a bit of a hiatus, but it's also, as you can see from the HCA data, has changed the product mix. There's a lot more open market and affordable home ownership schemes that have been coming forward, and very few social rents and a lot more affordable rents coming forward. So there's very much a change in the mix coming forward, and that's been reflected in our data, where we've seen that period of transition with sort of ups and downs really in the flow of project starts. I have to say, social housing provision actually has performed better than perhaps we would have expected, given all of that change. There's been a number of reasons for that, not least that it's not just ordinary social housing that's in that sector. There's been a growing area of delivery in terms of new student accommodation, and also in the elderly persons' homes market as well. Those are both going to remain positive areas going forward and strong growth areas. And you can see that they're now accounting for a minority, but a significant slice of the sector as a whole. So we can look forward for further growth in that area, which hopefully will help to offset, I think, what will remain a problematic area at the moment in terms of new social housing provision over the next couple of years. And we've got a pretty flat forecast, really, overall for social housing provision over the next couple of years. Similarly, if you turn to health, again, that area is going to remain relatively subdued over the forecast period. Government funding is restricted. It didn't suffer as badly as perhaps some of the other departments overall in terms of NHS funding when it first came in. But nevertheless, capital funding has been squeezed, and budgets. Plus, there's been a lot of reorganisation of the NHS over the last few years. There's very few new major hospital schemes coming through the pipeline. We saw sort of one or two start last year. There's very few new projects further down the pipeline that'll help to offset what we can see is really a bit of a consolidation in the sector at the moment, particularly that private primary care side of things, which hasn't been flowing through as perhaps you'd expect, because that's where the funding was starting to go prior to the last election. One perhaps positive area going forward is obviously it's not all NHS funding, particularly the private sector side of things is looking a bit brighter. And again, I think given the reforms that are going on now in terms of care homes and things like that, and nursing homes, I think we may start to see more private sector funding starting to become available over the next few years. Certainly the demand potentially is going to be there in terms of demographics over the longer term. So that's quite a sort of a dull picture at the moment. There are some positive areas within the public sector, in particular education. And that, again, that's been very much a demand-driven investment, and the demand's coming from rising pupil numbers, particularly in the primary school age. Over the current parliamentary period, the number of primary school pupils is growing by about 10%. Secondary school pupil age they're declining about 8% over that period. So you can see how these things tend to fluctuate. Now, Having said that, there might have been currently a decline in secondary school pupils, but given the rise in the primary school pupils, you can be pretty confident that there'll be a rising demand in due course at the secondary school age as well. Interestingly, if you look at the demographics as well, you see that growth in pupil numbers, but then it kind of plateaus out. It doesn't fall back. It's not like a sort of a bulge as such. So that really does mean there's a strong demand for increased accommodation in the primary school estate. And I think that's going to be a principal driver for the sector over the next few years. And we can see some, we've got pretty positive forecasts for primary school estates in particular. In addition to that, there's the priority school building programme. It's the £2 billion programme. A lot of that, again, tapping into private finance to deliver that, which is gathering momentum. And again, will feed into the sector over the next couple of years. So this we think is going to remain a positive sector over the medium term, despite the fact that obviously it's largely dependent on tight government finance. It's really going to be driven by necessity. Similarly, if you turn to transport, this remains a positive area going forward. The Network Rail CP5 programme, £38 billion worth of investment, is now underway from April, and that will be gathering momentum over the next few years. The road side of things is also looking more positive. We've already seen a rise in project starts over the last year in that area, and certainly, particularly post-election, the Highways Agency's budget is scheduled to be increased substantially. So again, that should support more investment in this area over the longer term. So take those things together with the continued impact of some major schemes like Crossrail, the enhancements to the tube network such as Victoria Station, even Thameslink, and then obviously perhaps outside this forecast period, things like HS2. All of those things point out sort of a pretty positive picture, I think, for the infrastructure sector, and particularly on transport over the longer term. Combine that with what's happening in terms of the energy sector, which again looks very positive over the medium term, with obviously schemes such as Hinkley Point going forward. But perhaps more fundamentally, I think the underlying growth in that sector is going to continue, whether that's investment in renewables and wind and waste from energy and those sort of schemes, or improvements to the transmission network by the national grid, as well as investment in new generating, non-nuclear generating capacity. All of those things, I think, will continue to feed into the sector over the next couple of years. And having sort of grown substantially over the last few years, we can see it remaining pretty stable going forward. Again, on the water side of things, there's a little bit of a fluctuation there. We've got the new AMP starting next year. So again, there's inevitably a little bit of a hiatus as those sort of things bed down. But I think in terms of new projects starting on site, it does remain a positive picture going forward. I'd now like to come back to, it's mentioned earlier on about the consumer being a lot more positive and confidence coming back there, and I'd like to sort of return to that in a little bit more detail. The graph there is really comparing real earnings growth after adjusting for CPI inflation against private consumption. You can see the relationship really quite clearly between the two. And if you're looking at the forecasts that are being put together by OBR and others, and we've adjusted those to allow for the inflation impact. You can see that over the next couple of years, A, the government is expecting a strong resumption in private sector consumption growth, B, that it's going to run ahead of real earnings growth. Now, there's a number of reasons perhaps why that should be sustainable, not least that we're seeing a strong growth in employment and falling unemployment, which means not only is average earnings growth rising fast over that period, but there's obviously more people in employment. Having said that, it does raise the question of, how will that be, as you get out to 2017, 2018, will that be inevitably continue to be sustainable? It also suggests perhaps that people are going to be borrowing more, saving less over that period, so they're dropping the savings ratio to sustain it. But I think as we go forward, it's certainly a more positive picture than we've seen over the last few years. But again, I think it's a question of, will we see perhaps a tick up in real earnings growth over and above what's currently being forecast at present, and certainly in nominal wage growth over that period, and perhaps the bank and others would like at this stage. Now that's got implications for key construction sectors. Taking the housing side of things first, clearly real earnings growth is going to have a major impact there. If you look at general housing market activity over the last couple of years, you can see that we saw the sharp fall in house prices and property transactions as the credit crunch hit, but we never really saw any recovery at all. Whilst there was perhaps a stabilisation in house price inflation, the current level of property transactions really failed to lift house prices at all until last year, when we started to see a bit more of a recovery coming forward. And I think there's a number of factors for that. One is that general improvement in confidence that we have started to see back coming through from consumers. But the second thing is there's been a number of initiatives that have been going on to help rebuild that confidence. A lot of those, interestingly, have been very much directed at the new housing supply. And it comes back to that Hillary's point, really, of trying to get that supply and demand back into balance, really, so that it doesn't all come through in a rise in house prices. The government itself has had a whole plethora of measures over the last few years, from releasing public sector land to support for home purchases. The Help to Buy really does seem to have been the one that sort of helped to unlock and breathe confidence back into the market. I think that's a measure of the scheme itself, but also perhaps a question of timing, that confidence was starting to come back there from consumers. And I think that's going to help to really fuel and sustain the recovery as we go forward. It was interesting in the last budget that the government the Chancellor made play of those two elements. He extended the Help to Buy for new homes out to 2020, whereas the second initiative, which was really support for people buying an existing second-hand home, effectively, he didn't change that at all. And that's a relatively short-term measure, really, to help get turnover going in the market. And it's been perhaps the thing that's been particularly singled out as perhaps being an inflation risk or a house price inflation risk going forward. So it's interesting that he didn't support that, an extension of that measure. In fact, he also said that he was going to make sure the bank was watching what's happening to house prices very closely over the next few years. Something that they do seem to be doing with some enthusiasm. I think the other interesting thing is, as well as those sort of in various initiatives to support demand and increase supply, there's been that planning reform. Coming back to their NPPF data, we recently did some research there that looked at the success rate of residential housing applications over the last few years, both before and after the NPPF came in. And as you can see from the graph on the right there, there's been a much marked improvement in the success rate of planning approvals. Interesting, we divide our schemes into large and small. Large is over 10 units, small is below that, sort of 3 to 9 units. And I think both have an improved success rate. Interesting, it's been the larger schemes that have always been more successful and continue to be so. And it may well come back to that point that Hilary was making about help for the small and medium-sized builders as well, to improve and grow the market alongside the work that the larger house builders are doing, to help unlock those smaller sites, to bring more of those sites forward, would help to perhaps give opportunities for those sort of developers to bring sites and add to housing supply. So we have seen a marked improvement in approval rates. We've also seen a sharp rise in applications and therefore in approvals overall. Sort of a 25%, 28% increase in the number of units being approved last year, which bodes well as we go forward. It just suggests supply is starting to improve. And it's not just in London as well. I mean, I think that's the interesting thing, is that if you look back a couple of years ago, a lot of that growth was coming from London and the South East. But if you look at the planning approvals during the course of last year, London remained firm but didn't go any further. But it was other parts of the UK that saw the sharpest rises in planning applications. So house builders are looking more broadly across the UK, and they can see opportunities emerging in other parts of the UK and they are putting in the applications and they're securing those approvals. And we should see a much more broadly based recovery, both in 2014 and 2015, across the country, in the Midlands, in the north of the country, as well as remaining strong in the southeast and London. So overall, we're looking at sort of growth of around 15% in terms of units, in terms of planning approvals this year, and further sustained growth of around 8% as we get into 2015. And it's really, as I say, as confidence continues to fuel demand and allows house builders to open up new sites, increasingly also they're going to be building out those sites more rapidly than they were a year or so ago as demand continues to rise. As that happens and activity accelerates, I think there are concerns about industry capacity, about skilled labour, about material shortages. And I think that's going to have to be an area, and that clearly is going to be a risk. I think given the length and the depth of the recession we've had, a lot of capacity has been lost. So it's meeting that challenge that's going to be the new challenge for the industry going forward. Some of that may be in terms of investing more in skilled training, investing more in manufacturing capacity and supply. But it also may be in the way we work our sites and the way we deliver them, and use more efficient building techniques and so forth to help to deliver those extra units. Moving on to the private non-residential areas such as offices, retail, and so forth. Again, we've seen a sort of a sustained, if somewhat hesitant recovery over the last few years. Some sectors have done better in some years than others, but I think the upward trend has been clear really since the depth of the recession in 2009, and we're expecting further sustained growth over the forecast period. But some interesting structural changes are going on in the mix of projects that we're going to see coming forward in all of those sectors over the next couple of years. And I think that the retail sector is a particular example of that. Where we're looking at an improving picture in terms of consumer demand and in retail sales. But at the same time, there's a lot of structural change that's going on within the retail sector with the rise of the internet, particularly the growth of click and collect now from not just the supermarkets, but from most major sort of national retailers. And how that's affecting their demand for retail space, how they use that space, and where it's located. And I think we're going to see that going to be really going to shape how projects come forward over the next couple of years. If you look at in terms of retail construction data, you can see that actually during the recession we had a bit of a renaissance in terms of retail construction in 2010, 11, even in 12 in terms of a growth in project starts. Now that was very much led by the supermarkets at that time who were continuing to invest in new major developments. But Tesco and Sainsbury's, who are the main catalysts for that investment, have been refocusing, and the others are now following, away from larger out-of-town stores towards their convenience store format. So we're seeing a strong growth in the number of stores, but a decline in the actual new floor space that's being provided. And this is you can see this from the latest new floor space data for supermarkets that have been in terms of planning approvals over the last few years. You can see that after a peak in 2011, there's been a steady decline in the amount of floor space that's being approved by the various supermarkets being brought forward for approval. And Tesco very much has led the charge in that switch. If you looked at other data, though, you'd see a very sharp rise in the number of stores that are opening, as they're very much opening these convenience store formats. And that fits in very much with some of that structural change that I mentioned earlier on, particularly with the click and collect. One of the challenges that the big supermarkets had in terms of these big out-of-town stores, particularly given the high fuel prices in part, was that they weren't getting the footfall, particularly in the non-grocery areas that they were expecting. And they're now looking at how they use that space. They're moving away from those. They're looking at click and collect, where they can have a wider offering than they could possibly at their Tesco Exo stores, with a much smaller footprint. And they're also looking at perhaps what they do with some of those big stores. I think they're piloting actually, putting in more coffee stops, reducing the size of those stores, and even converting the mezzanine floors that they've been busy putting in away from retail use into gyms, so that you can have a workout before you go shopping and get your donuts afterwards, I guess, after you've had a heavy workout. So there's a lot of refocusing and repurposing going on there, and I think that's going to be typical in the high street as well. There's a lot more repurposing going on there, looking at the existing floor space, a rationalisation of that, so the estates that they need, redesigning the existing stores so there's more of a click and collect facility available. So a lot more refurbishment in the pipeline. In addition to that, I think as people move away and the more is demanded, is being bought online, that's not going to be the end of shopping as we know it. In fact, I think we're going to see a lot more destination shopping going on. So we're going to see more investment coming forward in some big shopping centre schemes, which have been pretty notable by their absence over the last few years. Westfield, for example, is looking at extending its site in West London, pretty well doubling the size of the site there. It's already quite large, really trying to make sure that they've got a critical mass effectively in those sites where people will go for the day to shop. So I think that's hence the destination shopping. So much more mixed use, more leisure opportunities there, cinemas, restaurants and so forth, to help make sure that there's a catch there for people to go there and shop rather than just buying online. Moving on from retail to the consumer, to the office market, which again is seeing a sort of a firm demand growing for accommodation. If you look at the latest data in terms of employment growth for two key sectors, banking and insurance activities, and then professional services, you can see that there's continued rationalisation going on, and I think Barclays announced last week that it's going to again cut back on its investment banking arm again. So clearly there's going to be continued rationalisation on that side of things, but there's been strong growth that's been offsetting that in terms of professional services, and that's going to remain a growth area going forward. So you're seeing higher private sector employment in the office services sector, really helping to increase demand for accommodation over the medium term. And you can see that from some data here from Knight Frank. The red line there is the total availability of floor space. I've reversed the scale there, so you can see that the correlation there with the amount of floor space that's under construction. And you can see that as the availability has become tighter in the office market, that does spark, as you'd expect, increased investment in new office accommodation. And we've seen that strong growth really since in office demand since sort of 2010 onwards. It's kind of stabilised. It's still pretty tight at the moment, obviously off where it was in the previous peaks, but it's a sort of perhaps at a healthier sort of stabilised level. And I think that's been reflected really in the flow of projects that we've seen starting on site over the last year or so. In terms of we've already seen a strong growth in new project starts, but we're expecting some stabilisation as we get into this year. So having grown about 40% in terms of underlying project starts in 2012 and another 12% last year. A bit of a flat picture this year before seeing a resumption of growth as we get in 2015. Really reflecting that continued sustained growth. After all, employment growth, you'd expect employment to strengthen further as the pace of the economic recovery picks up and as employment continues to grow. Turning to the industrial sector, again, a more positive picture going forward. It's been a sector that was an early casualty of the economic downturn. What we've seen over the last few years is a strong growth, initially in planning approval, which is fed very quickly through to project starts in 2012. And then looking at last year, again, we saw another surge in planning approvals, which should support further growth during the current year. Now, the main sort of catalyst for that has been, in part, from the distribution and logistics sector. A lot of that being fueled by that structural change that's going on in the retail sector, increasing the demand for new logistics space to support that click and collect setup. Really, it does demand new types of space, not only because your distribution model is changing in terms of moving the materials and your products out to customers, but also increasingly you need to have sort of a return chain as well to deal with stuff that's being taken back and then has to be sent back up the line rather than just held back in stores it would have been in the past. In addition to that, business confidence is, as I was saying earlier on, amongst manufacturers is improving. And I think we're going to see over the medium term a strengthening in sort of the more traditional manufacturing investment going into new capacity. Certainly investment confidence is improving, but I think initially a lot of it's going to be going into plant and equipment rather than into new facilities. But over time, as demand continues to grow, you'd expect that to really help fuel investment in the factory space. So we've got a quite positive picture going forward over the next couple of years within this sector as well. So really just to try and summarise before I sort of take questions really, where we see the market going over the next few years. As I was saying earlier on, I think it's very much a private sector recovery that is now coming forward, which kind of fits in with what the government's initial objective was. It's just taken a lot longer to deliver than they hoped. Government funding generally is going to remain constrained over the next 5 years, where they continue to try and moderate government borrowing and bring down the budget deficit. But they are trying to provide, as I say, interestingly, a little bit more towards investment than they were in the last budget. Perhaps they have learnt going forward that they do need to invest a little bit more in the network, but as I say, in construction and delivering the network capacities that are needed to sustain growth. The challenge will be actually to make sure that those funds do come through at a time where they're trying to constrain overall government budgets, and there's going to be demands from frontline services and other areas demanding for their slice as well. But nevertheless, as I say, very much a private sector-led recovery, both from the strengthening consumer demand, helping to support areas such as the housing market, but also perhaps retail activity as well. In addition to that, an improvement in business investment, driving continued growth in office accommodation, in retail, hotel and leisure, which I haven't said too much about, so I can certainly take some questions on, in all of those areas, and obviously in industrial as well. So a much more positive picture as we go forward over the next couple of years, with broader base growth than we've seen in the past. So a positive picture for the next couple of years.
Thank you, Allan. Lots of information there. Well done for keeping going when the microphone wasn't quite going, so that's great. Any questions, please? Don.
Allan, I'm not sure whether you covered it, but I was just wondering whether there's any sign that we'll see any trend for more planning approvals around refurbishment and change of use, as opposed to new build. Hilary Benn was flagging the planning process. I don't hear any serious proposals to speed up planning processes for new build, especially greenfield. I just wondered whether you think any of your data points to more work on change of use and brownfield activity as well.
I think certainly the refurbishment side of things, and I think and brownfield development, I think that's going to continue, and certainly as the market improves, that's going to help defray some of the costs that particularly involved with developing brownfield locations. So that will help in that sense. The government's also obviously made a lot of changes to the planning system to try and help expedite the change of use, particularly for offices to residential accommodation. It's going to be interesting to try and track how quickly those and readily those come through. The first thing that happened, I think, is a lot of the local authorities said, yes, we support that, but not in these particular areas, which I think seemed to cover most of central London, I think, when they initially introduced that. So there are some restrictions there, but there is clearly a potential to perhaps remove some of the more redundant office stock to make sure the investment's going forward, because obviously a lot of the demand that we're seeing at the moment for office accommodation has got to be the right office accommodation. It's primary office accommodation, so but some of the existing stock is redundant effectively. So it's either got to be taken out or and converted either into offices and completely replaced with new office accommodation, or converted to an alternative use. So there are opportunities there.
Questions? I think perhaps I'll pose one. I mean, it was a really improving picture, Allan, but what do you think the risks are? I mean, both political and economic, to continued growth? Do you think there are any constraints, risk problems coming up in the next 3 to 5 years that may actually make the picture slightly less rosy?
Okay. Couldn't be too positive for too long, could we? It's going to be interesting to see what happens when interest rates rise, and they are going to rise because it's interesting how in fact, in a way, it's interesting how much the Bank of England is delaying it, saying it's next year. They're looking at increasing interest rates. I think there's clearly a danger there that perhaps some people are locked into the wrong level of affordable or unaffordable debt, effectively. So that could be a constraint on investment, particularly and the housing market generally, and confidence. So there clearly are risks there. That's going to have to happen. They are on a unsustainably low level. So it's going to be interesting to see how that one pans out. And then obviously there's a wider economic and world political environment, which is always an interesting one and difficult one to gauge. The other thing I'd say particularly about the housing market is that house prices are still very high in relation to earnings. You can see the confidence coming back there. The affordability in terms of people being able to get into the market has improved, part because of the government help, but it's not the only reason. But at the end of the day, they are, in terms of relations to earnings, still very high. So it's a question of whether house prices are stabilised, in part because we're building more homes to help bring supply and demand back into balance, and allow earnings to catch up, or we see a sharper rise in average earnings growth, particularly in nominal terms, and how would the bank then respond to those inflationary pressures?
I suppose there's also political risks, aren't there?
Yeah.
I heard John Criggin at CBI saying the other day, his nightmare scenario was the Scots vote for independence, that triggers an election, we end up with a Conservative government and a referendum about the EU, and where does that leave us for 5 years? I'll just leave that thought with you.
Yes.
Any further questions? Gosh, you're very shy this morning. I can see a hand half up there. Thank you.
So it's quite a positive picture across sort of broad base of sectors, but I was just wondering, on a regional basis, do you think that's going to be evenly felt, or how you see that coming through in the next couple of years?
Yeah, that's a good point, Matt, to expand on, actually. It's been very much London-centric over the last couple of years, particularly because of the office demand has been a growth there, and in the housing market. Strong demand there. A lot of it coming from overseas, as Ben was saying earlier on, in terms of supporting the residential, top end of the residential market. But we're looking at in the data there, and the housing is a good example of that in terms of handing approvals. So we're looking at a more broadly based recovery. So housing, yes, it's going to be more broadly based. And I think also in areas such as offices as well, there are signs that it is moving out. I mean, it's a slightly difficult one to watch because London dominates the picture anyway, because it's sort of about half the market. But we clearly are starting to see more confidence coming back to other parts of the UK in those sectors. So I think we are starting to see a more broadly based economic recovery, and not one that's just dependent on what's happening in London, which is got to be good news for the sustainability of economic growth over the longer term.
Final question, anybody? So, the microphone's coming.
Okay.
Down here, sorry.
Do you think with the sensitivity in the housing market, there's enough growth coming through to not affect the rents and so on?
Not at the moment, no. I think house prices will continue to rise in the near term. So, yes, I think it's interesting that those figures that we heard about, the 107 versus the 234, it just shows us the extent of the potential gap. I think the more we can close that gap, the more stable the housing market is going to be over the longer term. So it's clearly got to be it's interesting how the planning reform, it's interesting on the NPF actually, how they seem to see that as being a positive move, and they just want to sort of moderate it a little bit and try and make sure there's more brownfield development coming forward, and that actually the local authorities accept it and embrace it effectively and drive it forward. So I think that's going to be key to the longer term, but it's going to be a long-term reform. It's not going to help in the short term.
Okay, thank you very much.
Okay.
I'm sure we show our appreciation in the usual way.